understand and should ideally help them build and preserve their wealth through real estate. Many of our topics will be New Jersey focused because we are a New Jersey focused real estate investment company. And a lot of our investors live in the tri-state area and work and invest in the area here. But we'll also focus on the general real estate market, investment strategies in general, retirement strategies, tax planning, tax strategies, but mostly real estate investment tips for all of our webinars there. So let's get into it here. For those who are new to People's Capital Group here, we are a New Jersey real estate focused investment company. We work with over 100 investors and we help them build and preserve their wealth primarily through repositioning Class C and Class B apartment buildings throughout northern New Jersey, generally within an hour commute to Manhattan. We have a group called New Jersey Real Estate Network with over 5,000 members in it. We have events in person. For example, January 16th, we're doing an event in Jersey City at the 902 Brewing Company at 6 p.m. We'll send out an email about that in about a week or so. But if you'd like more information, you can also put your information there in the chat or the Q&A. And as we go along here, I encourage questions in the Q&A. Probably is the best place for everyone to put them. If you have any issues, if you can't hear me or see me, any technical issues, just let me know. I want to make sure everyone's getting a nice experience here and retaining this information I'll speak about here. So I'm going to speak for about 30 to 40 minutes or so, then we'll open up for questions. Again, I encourage questions as we go along. I see more and more people are jumping on, which is great to see. And let's get started here. So we're going to talk about understanding market cycles to improve your real estate investment strategy. We're kind of in an interesting time right now. We just had a new administration elected into our country, a real estate mogul. So we'll see where that goes. Of course, Mr. Trump was president before. We did see a lot of market growth during that time. We're seeing interest rates drop after a pretty extended period of higher interest rates, historically quite high compared to what we've seen in the past. Not quite as high as they were, say, in the 70s, but over the last 20 years, real interest rates have been quite high. So what effect does this have on our market? Where are we in the market cycle right now? And let's get into it. Quick disclaimer here. This is not a solicitation for funds, tax advice, or legal advice. I'll just be explaining how the last 14 years of real estate investing for me over the 300 transactions or so we've done in New Jersey here and building wealth for our investor base, what we've learned from our experiences and our studies here, and also done some more recent research. I always love doing the research for these presentations I put on because I learn a lot in that process as well. So I like to combine current market data and my experience to give the best presentation to our investors here. All right, so let's go into today's agenda. We're going to talk about the 4 real estate market cycles and where we are today in them. The next likely real estate market cycle that we should expect here in the next year or two. The main driving factors of the real estate market currently, and how to best invest in today's real estate market cycle, how to find those deals and make the best of what potentially could be great prices compared to what we could see in the future, and very high cap rates compared to what we've seen in the past. And how to prepare for the next real estate market cycle. Of course, you always want to be looking forward when you're investing, but also taking advantage of the present and learning from the past. All right, so let's get into market cycles here. This is a classic image here. Okay, this was made from the Mueller back from Real Estate Finance in 1995. This is a common teaching image here to be used and is still quite accurate for what we see with the market cycle. Now, where we are exactly in this cycle is a little harder to pinpoint. I put an arrow here, as you can see, that dark blue arrow. I believe, based on what I'm seeing in the market, the deals we look at, we'll look at 400 deals to buy one. So we are underwriting a lot of opportunities. We have a pretty good pulse on the market, at least here in North Jersey. Now, the thing about real estate, it's very local. So, you may have a different market a little bit elsewhere in the country or so on. But at least here in North Jersey, I believe this is where we are in this market cycle. So phase 1, let's start there. You have recovery. right? Where in that case you have declining vacancy. Most of the inventory on the market is getting saturated. It's getting leased up or purchased. There's not a lot of new construction going on because we're coming off era of high inventory. So builders are not very bullish on new construction. In this case, we had a pause in new construction because prices were quite high, and they are still kind of high compared to where they were perhaps pre-pandemic. But we had a serious pause in construction over the last 2 years as interest rates just skyrocketed from an era of very low interest rates. We had about a decade, really more than that, if you think from about 2009 to 2022, we had very low interest rates, right? So over a decade of extremely low interest rates. And what that did was fuel the market. And there were some ups and downs over that period of time, but for the most part, the market really grew. And building real estate penciled out nicely, meaning the cost of the land and the construction and the cost of borrowing the capital penciled out to a nice profit for the builders and developers. Therefore, the deals were funded and the development happened. We also have a shortage of housing. We still have a shortage of housing in the state here, also throughout the country. So what we saw over the last 2 years was high interest rates and prices coming down, at least in commercial real estate. Okay. For residential real estate here in North Jersey, at least, we really haven't seen prices come down all that much. They've actually gone up in some areas because there's just such a lack of inventory and such an insatiable demand for housing. Now, what we did see, though, was new construction really slowed down because, quite frankly, the deals just didn't pencil out. When you were able to get construction debt at 6.5% interest rate and build at a pretty reasonable cost of labor and materials, those deals happened. Large investors wrote the check, funded the operations, funded the construction, and buildings got built and housing developments got built. And that kept a pretty healthy amount of inventory on the market, although always kind of lagging a little bit behind demands, but that was good because you'd sell the properties quickly or lease them up quickly. Then about 2 years ago, rates really skyrocketed very quickly. There was some, just consistent increase after increase from the Fed because, quite frankly, they kind of let rates stay too low for too long. And there was free money fueling the market, and we had an inflation scare. It wasn't even a scare. We just had a lot of inflation, right? There was a big peak of inflation for a couple of years there, and it was scary. It was terrible, right? Prices for everything, groceries, cars, houses, rent, is skyrocketing, was skyrocketing. It's slowed down now. It's more around 3 to 4%, which is not quite at the Fed's target of 2% inflation, but we're getting close to that. So, inflation really reared its ugly head over the last couple of years. And because of that, the Fed aggressively increased interest rates and kept them there for probably longer than a lot of those economists thought they would. So the result of that was a big pause on construction. Now, it's not like people stopped needing a roof over their head or stopped having children. We, of course, continue to need housing and increased amount of housing. But for the last 2 years, the development really, really slowed down, especially here in North Jersey, but even more so in other areas of the country. So what that leads to is a slowdown in inventory and an increase in prices. Now, what we're seeing at this point is the Fed is dropping rates, and we expect rates to start to drop. Now, what's interesting is the Fed started dropping rates in September, right, of 24 this year. And what happened was everyone ran out and got a mortgage, at least in commercial real estate. Now, what I did, and I think, honestly, as they say, it's better to be lucky than smart. We locked in a mortgage rate. We're buying a 42 unit in Passaic, New Jersey right now. We locked in our rate at a 5.4 interest rate the day before the Fed meeting in September. And my mortgage broker told me if we lock that rate in today, right, just about 90 days later, so not even, that rate would be 100 basis points higher, meaning that 5.4 would be a 6.4 interest rate. So, yeah, again, it's better to be lucky than smart. I think in that case, if you asked me in September, I would have thought the rates would be lower now, but they're actually not because the Fed, even though the Fed dropped rates, what happened was the demand for debt increased because everyone saw the indication, hey, the Fed is actually dropping rates. Let's go out and get a mortgage. Let's start building real estate, whatever the strategy is. And that caused an increase in applications for mortgages, which led to an increase in interest rates. But what we should see is a decrease in interest rates over time, mortgage rates, okay, over time, and a continued drop in the federal interest rate as well. Now, mortgage rates are going to lag about 90 days behind the Fed drop, okay, because of what I just said, because the demand increases quickly, there's a bump in increase that causes a bump in actual interest rates. Interest rates are more fluctuated not only on the treasury rates, but also the demand for mortgages as well, right? The more people for applying for loans, they bump that rate up a little bit. And then as the applications drop, they lower the rate as well to encourage more applicants. So the bottom line is those rates are supposed to be dropping as interest rates drop, as the Fed continues to drop rates, and we should see mortgage rates drop into 2026. So that will allow more real estate development projects to pencil out, and that will encourage more developers and builders to actually break ground and start developing again. What we're also seeing is a lot of supply in the market, at least somewhere like Jersey City or something like that, where rates were so low for so long. Keep in mind it takes about 2 years to build some of those big projects. The bigger the projects, sometimes 3 years. Now, if you don't have approvals for your project, that could take 2 years in itself. So if you go back 5 years, right, you're looking at a low interest rate environment and a lot of building going on. So much of what we're seeing hit the market right now is just rollover inventory from an era of low interest rates. Now, these builders had to go through, hopefully they didn't have a flexible rate mortgage, but if they did, there goes their profit. So they're pretty much getting soaked there. But at the same time, the value of those rentals or sale of the assets have gone up. So maybe they're doing okay with their exits. But the bottom line is what we're seeing right now in the market is kind of from the era of low interest rates, that inventory hitting the market, getting saturated at a pretty healthy pace. The rental market is strong. It has been stagnant for about 18 months, meaning rents haven't really grown all that much. Although I know with a lot of our buildings, we're still catching up to where rents need to be on our buildings, especially in our rent controlled buildings where you're only allowed to increase rent 5% a year. I mean, rent increased by 8 to 10% a year in some of those markets. So if you're limited to 5, you're still catching up just to get, over the last 4 years, if rent increased by 35% and you're limited to 5% a year, then we're still catching up to where the market rent is for a lot of these units, which leads to a continued increase in net operating income in those buildings, even though market statistics show that rental prices have been a bit stagnant over the last 18 months or so here in North Jersey. But what we're seeing now is a decline in building. Therefore, we expect a decline in inventory. The current inventory on the market is being saturated and rates are coming down. So what we should see next into 26 and 27 is declining vacancy and new construction. That's going to lead to more inventory on the market. That's, of course, phase 2 expansion. So I think we're not yet there. We're still kind of in the midst of phase 1 recovery. But we should prepare for phase 2 expansion over the next 2 years or so. And then phase 3 hyper supply, right, where a lot of those developments are now hitting the market. And you'll see an increased vacancy, right, more inventory, more supply than demand. Okay. And new construction continues in phase 3 of hyper supply. So this could be perhaps in 28 or 29. Of course, it's hard to foresee the future into that far. And then, of course, phase 4, recession, which is pretty much what we just experienced, where you have increasing vacancy and more completions, right? The lag of real estate development and construction being completed. Remember, if you start your development at the top of the market here, you're really not done a lot of times until not only phase 3, but right into phase 4, especially if you're not getting into an approved development. It could take 2 years for approvals, 2 years for development. So you could be going through 2 different phases through that period of time, or at least one. So what we're seeing here is that exact thing, and more completions. We're not seeing an increase in vacancy. We're actually seeing a decline in vacancy, and not a lot of new construction starting, But I think we're going to see more new construction starting. I know here at People's Capital Group, we're looking at new development opportunities. We are bullish on new development. If you can get the land for the right price and team up with a good builder, then it can be a great opportunity because there is a lack of housing supply on the market, and we do need more quality housing. And I'll talk about that here in the next few slides. Okay, so let's get into market drivers. What is driving our market today? So as I was saying, lowering interest rates are really a big factor. That makes everyone happy for the most part, quite bullish on where we think the market will go next. The Fed has indicated they're going to be dropping rates again in December here very shortly, and also possibly in January, more likely perhaps in February or March. So the bottom line is the Feds are going to probably keep dropping rates. You'll see mortgage interest rates kind of lag behind that by about 90 days. But, if you don't have to refinance now, wait a little bit. Here at People's Capital Group, we have two buildings that are repositioned, ready to go. And net operating income is 10, 15% higher than we initially targeted. And these buildings are humming along very nicely. But we don't want to refinance right now because we have really great rates locked in on these buildings. And yes, it'd be great to be able to refinance and get a large liquidity event for our investors. Everyone loves that. But at this time, we want to be long-sighted. And we want to recognize that we have a nice interest rate. Let's continue to cash flow a little bit on these assets, and then let's harvest that equity growth perhaps middle of next year. We'll see where rates are at that time. So I would suggest the same for you as well. If you don't have to refinance right now, then wait to see what happens next year. Low vacancy. So New Jersey has a shortage of 214,000 affordable units. That's more the affordable housing situation there in New Jersey. We also have a rental vacancy rate of 3%, which is extremely low. In fact, it's the third lowest in the nation. So what we're seeing here in New Jersey is just a serious a lack of inventory and an insatiable demand for housing. And that leads to a very low vacancy rate. Some other markets are up above 6 or 7 or 8%, right? And I know like Austin, Texas is struggling. A lot of areas where development is a little easier. People always say, guys, why do you invest in New Jersey? Why does People's Capital Group invest in New Jersey? Why don't you go to Texas where all the other syndicators are syndicating, or the Carolinas or Florida? Don't you have access to the headlines? Well, of course. But one of the things we like about New Jersey, not only do we focus on this market that's an hour commute into New York City, so there's just a consistent demand for housing here, it is harder to build. It is harder to develop. There is more red tape. And what that means is there's less inventory hitting the market, or at least it's hitting the market at a slower pace. And that helps improve our real estate values and our rental prices. It's almost an insurance policy that North Jersey real estate will always have a high demand because it's not easy to oversaturate a market where there is a little more red tape to development. If you know how to navigate that red tape, you could do well as a developer, a builder, or a landlord. But being that it is harder to develop here, that's one of the things I actually like about North Jersey, and one of the reasons we actually invest here. So it's really a double-edged sword in a lot of ways. So low inventory, right? So that's what I'm saying. It's hard to develop here, so therefore we have lower inventory, but it's still a very strong demand to live within an hour commute to Manhattan or just to North Jersey in general. We've had a 43% drop in new housing permits from December 2021 to now in New Jersey. We've had 48% less homes on the market from January 2020, so right before the pandemic. So a couple things going on there. Rates started to increase kind of after that December mark, but not too far after that. And therefore, a lot of builders, also we felt like the market was a little tapped out at that time. Inflation started to take off. It caused an increase in building costs, labor costs, and that led to a lot of builders and developers hitting the brakes on new development, right? Around the end of 21 to 22 as inflation really started to take off then. And also what we saw just pre-pandemic and into the pandemic was a lack of people actually selling their house. most people locked in an incredibly low interest rate, like an artificially low interest rate, 3%, even some below 3%, right? It's ridiculous. That's essentially free money. If inflation's at, 4% and the cost of your debt is at 3%, that's essentially free money. The value of your home is growing faster than the cost of your debt. So really nice place to be as a homeowner. So why would you sell if you don't have to sell, right? There's no reason to sell your property. There's no reason to lose that incredibly low interest rate, especially if you're locked in for like 30 years. It's a genius move. So therefore you have the lock-in effect, right? You're really not going to sell your home if you have a great interest rate, unless you have to, right? And there's scenarios, of course, where you have to sell your home, or you're retiring, you're moving, you got a new job somewhere, right? Divorce. There's a million reasons, of course, to sell, but essentially, if you don't have to, you're not going to right now, right? Until rates really drop to a reasonable point, and they're just not there yet. So that's called the lock-in effect. So we are seeing that right now. So very few people are selling their homes, putting them on the market. They're just saying, oh, we'll wait till rates drop. We'll see where the market goes. Values have continued to go up. So why would you sell anyway if you don't have to? And if you're going to go sell your home and buy a new one, you're going to trade out a 3% rate into a 7% rate. Well, that's not a smart move. You're just going to be basically buying a much smaller home at the end of the day. So that's why you see very few homes on the market. What you do see is a lot more new inventory on the market. See, in the past, what we saw, like pre-pandemic, I think new inventory on the market was around like 10 to 15%. Now I believe new inventory on the market is around 25% or so. So what that tells me is less people are listing their home for sale, and more of the properties actually trading are new development assets. So that's a pretty incredible change here in what we're seeing on the market. We see that really throughout the nation. Another reason why we need to keep building real estate and creating new quality housing here in North Jersey. All right, so solution to New Jersey's housing crisis. So, of course, it's really a supply and demand issue. There's not enough supply, and there is an insatiable amount of demand. So we need to build more quality housing in high demand locations. And the way we do that is we look at approved projects. PCG here, People's Capital Group, we're always looking at newly approved projects, and we're always working to vet those, underwrite those with our underwriting team, and bring them to our investor base if it is a great deal, and then work with an experienced builder to get that built. Repositioning. This is really our bread and butter. We've been doing this over the last decade. We started our company in 2013. We bought a 25-unit apartment building that was mismanaged with rents below market value, outdated amenities, really no amenities, outdated units. And we improved this vintage housing, these older apartment buildings in need of renovations. And we improved the management with our in-house management company. And we reposition these assets over time. We make them a more desirable place to live. We improve the net operating income on these properties, and that allows us to then complete a cash out refinance over time or sell these properties over time for a nice profit to our investor base. So repositioning old vintage housing, especially in the multifamily space, is a great way to ease New Jersey's housing crisis. And this all cannot happen unless people invest. And that's one of the reasons we started People's Capital Group, is because we like bringing off-market deals, opportunities that the average investor normally wouldn't have access to our investor base, our private investors, who are generally accredited investors or high net worth individuals, even family offices and people working with registered investment advisors. And about 40% of our investors self-direct their IRA into real estate as well. So all types of investors that invest with us, and all different types of investment groups as well. We need to work together to build more real estate, reposition vintage housing, and solve New Jersey's housing crisis by investing together in real estate. So how do we prepare for the next market cycle, right? As we mentioned on the third slide there, we are kind of in the midst of the phase one right now. Rates are starting, well, supposed to drop pretty soon. I mean, technically the Feds are dropping their rates. We haven't really seen it reflected in mortgage rates all that much just yet, but we will shortly. And that's going to help more development pencil out and more buildings start getting built. But we've also seen prices drop. Commercial real estate has dropped by about 25%. Cap rates have gone up, meaning prices have come down. So it is a great time to buy if you can find the right deal. but it's still a very competitive market as well. So if you're not an experienced real estate investor and you don't have experience building or developing or repositioning apartment buildings, then you want to work with a team that can source discounted off-market properties, take advantage of this market where you have great opportunities for discounted prices, and renovate them over time, build value into them, reposition them, and either sell them or refinance them over time. Consider self-directing your IRA. Right? A lot of people have their IRA or their 401k primarily invested in the stock market, and the stock market's had a good run. But I've also read a lot of articles saying that it's a bit tapped out, and a lot of economists are expecting slower growth in the stock market over the next few years. However, real estate, I believe, is at a price point where it's quite affordable, at least the market we're in, compared to what we were seeing in 2022, 2021, buying at 4.5 cap rates. Now we're buying those same types of buildings at 6 caps, right? So much better prices. So take advantage of a better priced market here in real estate, buy low and sell high. About 40% of our investors self-direct their IRA into real estate, which is a great way to diversify some of your IRA out of the stock market into real estate. 1031 exchange, right? The market values have increased nicely over the last decade, especially since the pandemic. I mean, values skyrocketed during the pandemic. So if you've owned a piece of real estate over the last 5 or 10 years, it's probably worth a whole lot more than you purchased it for, especially if you maintained it well. And you might want to look at selling investment properties you've built equity into and defer your, especially the residential properties. Like let's say you have a 2-family as an investment property or a 4 or 6-family as an investment property. Those properties still are really holding their value very nicely. So take a look at those values. You probably have a lot of equity built in over the years. You could sell the asset through a 1031 exchange, defer your capital gains tax, reinvest or exchange that principal and profit into another discounted commercial asset. See, the play there is, for example, duplexes or basically anywhere from 1 to 4 units have really continued to grow in value. The reason these buildings have continued to grow in value is because the demand for owning a property and living in the property have continued to flourish, especially here in North Jersey. However, when you get above 4 units, so 5 units and up, you go into the commercial realm. They don't qualify for owner-occupant loans like FHA loans, and you get commercial debt as well. So the bottom line is commercial real estate, larger assets have dropped in value, where smaller assets like 2, 3, and 4 unit buildings have grown in value very nicely over the last 2 years. So a good play could be if you own a duplex as a rental property, consider selling that property, doing a 1031 exchange, and trading into a commercial property that could be purchased at a discounted price. Now, it is much harder to buy and manage and own a 25 unit over a 2 unit. And realistically, you're not going to sell a 2 unit and be able to afford a 25 unit. But if you work with a syndicator that can accept 1031 exchange capital, that is a great way to get into a larger building, own a piece of that building, be a passive investor, and exchange a ton of equity growth that's been built into your property over the last few years and get into a discounted commercial real estate asset as a passive investor. That is something we do here with landlords and owners at People's Capital Group. So consider investing in new development as well. With a 2-year lag in new development due to high interest rates, investing in development now will likely pay off in the future, right? So that I believe is a good time to get into new development as long as the deal pencils out properly. All right, let's give a quick insight into our 5-year plan here, People's Capital Group. Then I'm going to wrap up for questions in about 5 minutes here. So right now we're closing on a property. We're growing our AUM to about 40 million here in northern New Jersey. It's a 42-unit value add building in Passaic, New Jersey. Rents are about 30% below market value. Kind of a classic Class C building we can reposition into a Class B. So we'll be closing on that in about 3 weeks, actually. We have a couple spots left for investors. So if you want to learn more about that, I'm going to put a link in the chat there. You can schedule a call with me, or you can also just write in the chat there your email or phone number. We'll get in touch with you as well. In 2025, we're going to refinance 2 or 3 assets, creating a liquidity event for many of our investors. We plan to also raise an additional $10 to $20 million and acquire a $20 to $40 million asset, ideally a larger asset around 100 units or so. In 26, we plan to raise $25 million and acquire $50 million in assets. We'll be working with RIAs, broker-dealers, family offices, and accredited investors to achieve that goal. Then 27, we plan to raise 50 million and acquire 100 million in assets. We may go into a fund structure in 26 where we're creating a fund, buying multiple properties. It's just quite frankly easier to execute, to put that money to work when you're able to buy multiple properties instead of one large acquisition. Right now, we do direct investment in structure. So essentially, we're buying one property with one fund. So the property we're buying right now, we create PCG Fund 3. We're buying that one property with that fund, and those investors are invested just in that building. We'll probably do that for one more year. I think in 26, we're going to go to a true fund structure where we're creating a fund and we're buying multiple properties in that fund. There's benefits to both. I mean, a lot of investors like investing directly in an asset. They know exactly what they're getting. Other times, there's the benefits of diversification and being invested over a number of properties through a fund. So there's benefits to both. What most of our investors do is just get into as many investments with us as they can through the years. We try to present about 2 opportunities to our investors per year. And by investing in multiple direct investments, you do diversify your wealth over multiple projects as well. And then around 28 to 29, we plan to start harvesting those assets that we've built and purchased and repositioned over the last 5 years and creating liquidity events for investors at that time. And that's what everyone loves, those nice liquidity events. So quick note here, who invests with People's Capital Group? Well, we work with all types of investors. We work with generally accredited investors. Now, by the way, an accredited investor is someone with a net worth of $1 million, not including their primary residence, or an income of $200,000 individually, or $300,000 including their spouse. But we also have options for non-accredited investors, such as our debt fund, where investors earn a quarterly interest payment and hold a promissory note. But for the most part, our investors are accredited investors investing in apartment buildings with us. C-suite executives, usually working in New York City 50 to 60 hours a week to support their families. They don't reasonably have time to look through 400 deals to buy one, manage and reposition apartment buildings as we do here at People's Capital Group. And so it's a nice marriage where we can help them build and preserve their wealth through many tax benefits and create cash flow and large liquidity events upon refinance or sale. And they can focus on what they do best and earn a strong income with what they do and reinvest some of that income over the years into real estate investment opportunities in a high demand market here in North Jersey. We work with police officers and sheriffs, people servicing our community and keeping us safe, seeking to ensure a path to retirement. Sometimes a pension isn't enough, so those individuals are able to put a little bit into our investments as time goes on. Teachers, mothers and teachers and fathers, people helping to educate our youth and prepare the next generation for challenges in life. Doctors, physicians of all specialties who work to keep us healthy, seeking to create passive income and pay less taxes. You know, a lot of doctors that invest with us, they are so busy. We see how busy they are, and we respect that, right? Where would our society be, of course, without doctors and physicians? And our job is to make sure that their investments are well cared for, are producing as targeted, and that we're taking advantage of all the tax benefits. All right. Because when you create a certain amount of wealth, it's not just about the return on investment, it's also about how you preserve that investment and make sure you keep what you earn. Right. It's not just what you earn, it's what you keep. Right. So by taking advantage of things like cost segregation studies and tax depreciation, we protect our investors' wealth. And we also do monthly updates and quarterly financials. The K-1 tax returns are done for them on an annual basis. So it's a completely passive experience for someone like a doctor who could be working 60, 70, 80 hours a week. We're able to create a nice environment for them where they can invest with confidence, log on to their investor portfolio and their investor platform with us and see how their investment's doing as a completely passive investment. Professionals, lawyers, accountants, engineers, insurance specialists, business owners, authors, managers, entrepreneurs, seeking to make their hard-earned money work harder for them. So one more note here on why we invest. I personally have a 3-year-old son. I invest in real estate to create legacy wealth. I want to make sure there is a nest egg, a well-protected, tax-advantaged investment portfolio for him to have as I pass on this world one day. Although I'm only 37, so hopefully that's not for a very long time. But also more, other reasons are to work less and enjoy life more. Passive income is key. Financial freedom is key to enjoying life, right? Money doesn't solve all our problems, but it does make it easier to enjoy life and enjoy time with your friends and family and loved ones and preserve our wealth long term, right? The worst feeling is when you work hard all your life and you save up your money only to give it to the IRS, or you do well on an investment, you have a nice liquidity event only to give that all to the IRS. So you want to have a good tax strategy. We always try to have another option for our investors. Say if we are selling an asset, we want to try to have another asset for them to 1031 into, or do a lazy 1031 where we sell an asset and then buy another one in the same tax year and do a cost segregation study to write off those gains. That's a great way to write off gains from a previous liquidity event. So we're not just about buying and repositioning and exiting real estate here at People's Capital Group. We're really about building a relationship that's lifelong, solving your financial issues, having a tax strategy. And one more thing I really like to do with my wealth personally is to have an impact on issues that you care about. One of the reasons I want to be wealthy and I want to have essentially a family office at some point, ultimately, is because I want to have an impact on issues I care about. These can be social issues, economic issues, issues that we really want to have an impact on. I personally like to give back to World Vision. I think they're doing great things throughout the world. And I like to donate to my church as well. So, whatever's important to you, it's amazing to be able to have a true impact on that. And by investing wisely, creating wealth, building and preserving your wealth through the years, you can have a real impact on issues you care about. And that's an amazing accomplishment, an amazing feeling. That's some of the reasons we, of course, invest. So finally, thank you to our investors. We're only successful as our investors. Our success is your success. So let's keep it up. Let's keep building our wealth together here in North Jersey real estate. Since 2013, many people have been investing with us for over 10 years. Teamwork, PCG would not be succeeding without the support of our loyal investor base and our employees here at People's Capital Group. So thank you to everyone there. And common loyalty, 81% of our investors reinvest after a liquidity event. And that's an amazing thing. So we really love uh, not only, of course, finding great deals for our investors, but executing with integrity, doing what we say we're going to do with consistent communication and updates to our investors. And then, of course, continuing to build our wealth. It's a lifelong relationship. So that's our goal, People's Capital Group here. I hope you enjoyed our presentation, my presentation on the 4 market cycles here. We talked about where we are in today's market. I think we're kind of coming out of that bottom part of the graph, and that's good. That's the good news. I think we're over the hump. I think we're looking on to better horizons here. As you can see, this beautiful horizon in the background. That's kind of what we're looking at as the sun rises there. So hopefully we're seeing better days ahead of us here in the real estate market. And that's what I believe we are headed. So I think it's a great time to buy commercial real estate. Prices have dropped 25% in many markets. So keep an eye out there for great deals right now. Consider exiting an asset class such as residential real estate, 2 to 4 units that have grown very nicely, and 1031ing into commercial real estate, which has dropped in price. If you want to learn more about that, let's connect and consider diversifying some of your IRA out of the stock market, which has had a great run for the last decade, and now maybe diversifying some of that into real estate where prices are lower and the opportunities are prevalent. So that's it for me here at People's Capital Group. I'm Aaron Fragnito. Let's see here if we have any questions. Usually that means I did my job pretty well if I don't see any questions. So, all right. So I don't see anything here in the, let's see, Q&A. All right, no questions right now, which no problem there. If you would like to get a copy of this, you can always reach out to us here at People's Capital Group. I'm going to actually see, I'll put our link here to get in touch with us here at People's Capital Group. And the next steps here, if you want to learn more about what we have going on, is to schedule a Zoom meeting. Once we schedule a meeting together, we can talk about your investment goals, see if they align with what we're doing here at People's Capital Group, or at the very least, just talk to you more about what we're seeing going on in the market and how we've helped people build and preserve their wealth over the last decade. So I'll leave that a link up there for a couple more minutes if you'd like to click that link and schedule a call with me, Aaron Fragnito. Thank you so much for joining. We saw a lot of people jump on here today, which is great to see. We'll be doing another one of these educational webinars in about a month. We'll have a new topic out to you as well. And if you want to join our live event, that's January 16th in Jersey City at the 902 Brewing Company. Thanks a lot. Have a great day.